Let me tell you something that sounds impossible. The last time gold and silver sat exactly where they are today, gold went up 240%. Silver went up 320%. But here is the part nobody tells you. It did not happen the way you think. Central banks were dumping gold for months. The headlines were screaming that the trade was over. Financial commentators were writing its obituary. And then, quietly, almost invisibly, something began to flip. The smart money moved first. Retail investors found out last. Most of them never found out at all. Today I am going to show you exactly what flipped, when it flipped, and what it means for your financial future. Because there is a mechanical pattern at work here. It is repeated after every single major crisis in the last 50 years. 1973, 1979, 1991, 2001, 2022. And it is repeating right now in real time, whether you are watching it or not. I want to be honest with you from the very first minute. I am not here to hype a trade. I am not here to sell you a dream. What I am going to give you today is the framework, the rules that Wall Street's most sophisticated investors use, so that you can look at this market and make your own informed judgment. Because the problem with most financial content is that it gives you fish. What I want is to teach you how to fish for yourself forever. Every crisis in the last half century has temporarily punished gold and then rewarded patience beyond what most investors could have imagined. Here is what makes today different from anything we have seen before. The United States is paying $3 billion a day in interest on its national debt. That is more than the entire annual defense budget. Central banks, the most powerful financial institutions on earth, have quietly shifted from selling gold to buying it at a pace not seen in decades. And gold right now is trading significantly below the technical level that every major institution, every sovereign wealth fund, every serious hedge fund watches like a hawk. That combination, historically extreme debt, central bank accumulation, and a technically suppressed price, has never existed simultaneously at this magnitude. And the investors who understand this before the mainstream do will be positioned very differently from those who find out later from a headline. By the end of what I am sharing today, you will understand the four-phase cycle that follows every major oil shock. You will see why the current pullback in metals is not a breakdown but a setup. You will understand which signals separate the moment of maximum fear, which is the moment of maximum opportunity, from genuine structural failure. And you will know exactly why this moment, uncomfortable as it feels, is the kind that serious investors study for years and wait for patiently. So let us start with the question that is probably already on your mind. Why, in the middle of a global crisis, is gold going down? Picture the scene. The world is on fire. A major conflict erupts in the Middle East, oil prices begin climbing, and every financial news channel on the planet is running the same chyron: global uncertainty, market volatility, economic disruption. Every retail investor who has ever read a single article about gold rushes to the same conclusion. This is the moment. Gold is a safe haven. Gold goes up when the world falls apart. This is exactly what I bought it for. And then gold drops, not a little, not a gentle correction that tests your patience for a few days. We are talking about a significant, sustained, gut-wrenching decline, the kind that makes you stare at your screen and wonder whether you fundamentally misunderstood something, the kind that makes you feel, in the cold language of the brokerage statement, genuinely wrong. Here is what I want you to understand before we go any further. You were not wrong about gold. You were wrong about the timing, and more importantly, you were wrong about the mechanism. Those are two very different things. Being wrong about timing is a recoverable mistake. Not understanding the mechanism is the kind of error that costs you money not once, but every single time the cycle repeats. And this cycle has repeated with remarkable consistency for the last 50 years. The moment of maximum fear in gold is almost never the beginning of the end. It is almost always the end of the beginning. So let us talk about the paradox, because once you see it clearly, you cannot unsee it. Gold is priced in US dollars. That sentence sounds simple, almost trivially obvious, but it contains everything. When a genuine geopolitical crisis unfolds, a conflict, an oil shock, a moment when investors around the world feel genuine fear, something very specific happens in the global financial system. Money does not just sit there paralyzed. Money moves. And where does money move? Into the one asset that the world's institutional investors, pension funds, and sovereign wealth managers still treat as the ultimate safe haven, which is not gold. It is U.S. government debt. It is the American dollar. Every scared investor on the planet, every fund manager who cannot afford to be wrong, every institution that manages retirement savings for millions of ordinary people, they all do the same thing at the same moment. They buy dollars. They move into U.S. treasuries. And because gold is priced in those very same dollars, a strengthening dollar mathematically makes gold cheaper in every other currency on earth. Gold does not fall because it has lost its value. Gold falls because the unit of measurement, the dollar, has risen sharply against everything else, which mechanically depresses the gold price, even as the underlying demand for real assets quietly builds. And that is only the first headwind. Simultaneously, the expectation of higher oil prices pushes inflation expectations upward, which paralyzes central banks. The Federal Reserve cannot cut interest rates when inflation is expected to rise. So bond yields climb as the market reprices the future path of rates. And when U.S. government bonds are paying 5%, a guaranteed risk-free return, institutional money has a very simple question to answer. Why hold gold, which pays nothing, when I can hold treasuries, which pay 5%? The answer for most of that institutional money is that they should not. So they sell gold to fund the rotation into bonds. The price drops further. Then you add the third headwind. There are institutions and funds that entered gold much earlier, when the first buy signal appeared, and they are sitting on enormous profits. A crisis creates liquidity pressure. When markets are volatile, risk managers want cash. So some of those long-term holders begin selling, not because they have lost faith in gold, but because they need to raise liquidity, rebalance portfolios, or simply lock in a gain before the situation becomes unpredictable. Three forces arriving simultaneously, all pointing in the same direction. And every single retail investor who bought gold because the world looked dangerous is now sitting in the red reading headlines that confirm their worst fear and wondering whether they made a catastrophic mistake. Most of them sell. And the moment most of them sell is historically very close to the moment the smart money begins accumulating in size. That is the paradox. The moment that feels like the worst time to own gold is mechanically almost always the setup for the next significant move higher. Understanding why that is true is not a matter of opinion or optimism. It is a matter of understanding the sequence, the precise, repeatable, mechanical sequence that has played out after every major oil shock in living memory. Most people think markets are chaotic. They watch prices move up and down and conclude that nobody really knows anything, that it is all noise, that the whole thing is essentially a sophisticated form of gambling dressed up in the language of analysis. And I understand why they think that if you are watching gold fall during a geopolitical crisis without understanding the underlying mechanics, chaos is a perfectly rational explanation. But chaos is not what is happening. What is happening is a sequence, a precise, ordered, mechanical sequence that triggers the same way, in the same order, every single time a major oil shock hits the global economy. Tattoo this somewhere, you will not forget it, because once you understand these 4 steps, you will never look at a market crisis the same way again. You will stop reacting to the news and start reading the sequence. And reading the sequence, rather than reacting to the noise, is the difference between the investor who panics at the bottom and the one who was quietly positioned before anyone else noticed the opportunity. Step 1 is the geopolitical shock. A conflict erupts, a major oil-producing region is disrupted. 20% of the world's oil supply flows through a handful of critical choke points, and when those choke points come under any kind of threat, military, political, economic, the market does not wait for confirmation. It prices in the fear immediately. Oil begins to move. not because supply has actually been cut yet, but because the expectation of disruption is itself enough to move prices. Markets do not trade reality. They trade the anticipation of reality, and that distinction matters enormously for everything that follows. The sequence does not care about your opinion of the situation. It runs whether you are watching it or not, whether you understand it or not, whether you are positioned for it or not. Step 2 is where most beginners get confused because it seems counterintuitive. When oil spikes, actual inflation does not rise immediately. Supply chains take time to absorb higher energy costs. The price increase at the pump takes weeks to filter through to the grocery store, the shipping container, the manufacturing floor. But inflation expectations, what the market believes inflation will be in 6, 12, 18 months, those rise instantly. And in financial markets, expectations are not a secondary consideration. They are the primary one. The bond market, the currency market, the equity market, all of them price the future, not the present. So the moment oil spikes, inflation expectations spike with it, and that single development sets the entire remaining sequence in motion. Step 3 follows with an almost mechanical inevitability. The Federal Reserve, which has been under pressure to cut interest rates to support a slowing economy, suddenly finds itself paralyzed. You cannot cut rates when inflation expectations are rising. Cutting rates into rising inflation expectations is the one thing that every central banker in the modern era has been trained to avoid above all else. So the Fed goes quiet. The rate cuts that the market had been pricing in, the cuts that were already baked into asset valuations, into mortgage rates, into business investment decisions, those cuts disappear from the calendar. The Fed cannot move. And a Fed that cannot move is a very specific kind of signal to the bond market, which brings us to step 4, and this is the one that directly explains why your gold position is in the red while the world appears to be falling apart. When the market understands that the Fed is frozen, it reprices interest rates on its own. Bond yields rise, and bond yields are not set by the government or the central bank, regardless of what most people believe. They are set by the market, by the collective judgment of every institution, fund, and sovereign entity that buys and sells U.S. government debt every single day. When those yields rise to 4, 5, or 6%, institutional money faces a straightforward arithmetic question. Why hold gold, which yields nothing and is currently falling, when U.S. Treasuries offer a guaranteed return of 5%? The answer drives enormous capital flows out of gold and into bonds. The dollar strengthens as foreign capital rushes into dollar-denominated assets, and gold, priced in those same strengthening dollars, falls further, creating the exact picture that looks, to the uninformed observer, like gold is broken. It is not broken. It is being temporarily overwhelmed by 3 simultaneous headwinds, all of which are predictable, all of which are finite, and all of which have resolved the same way in 1973 and 1979, in 1991 and 2001, and in 2022, with gold eventually recovering to levels that made the panic sellers look back with the particular regret reserved for those who understood the story but could not hold their nerve long enough to see the ending. There is a phrase that gets repeated so often in financial circles that it has lost almost all of its meaning. Past performance does not guarantee future results. You have heard it 100 times. It appears in the fine print of every investment product, every fund prospectus, every disclaimer ever written by a compliance department. And technically it is true. But there is a version of history that is not about past performance. It is about mechanical causation. It is about the same set of conditions producing the same sequence of outcomes, because the underlying forces, human psychology, institutional incentives, the structure of global capital flows, have not fundamentally changed. That is not past performance. That is pattern recognition. And the pattern we are looking at has held across 5 decades, multiple continents, and every variety of geopolitical disruption the modern world has produced. Go back to October 1973. OPEC slaps an embargo on the United States in response to American support for Israel in the Yom Kippur War. Oil does something the world had never seen before. It quadruples in price almost overnight. The inflationary shock is immediate and severe, and gold, in the initial period of the crisis, does not moon. It stumbles. The dollar strengthens, institutional money seeks the safety of U.S. assets, and the same four-step sequence we have already mapped plays out with textbook precision. But then, over the following months, something shifts. The suppression forces exhaust themselves. The dollar peaks. Bond yields plateau. And gold begins one of the most significant multi-year rallies in its modern history, recovering every loss and then climbing far beyond where it had been before the crisis began, then 1979. The Iranian Revolution removes one of the world's major oil producers from the market almost entirely. Oil prices double. Inflation in the United States runs into double digits. And gold, after an initial period of mechanical suppression driven by the same dollar and bond yield dynamics, goes on a run of approximately 89% over the following 12 months. Not 89% from the bottom of some obscure bear market, 89% from a price that was already elevated by historical standards. The investors who understood the sequence and held their position through the painful early phase were rewarded in a way that the investors who sold during the suppression period could only watch from the outside. Every crisis produced a temporary winner and a permanent lesson. The temporary winner was the dollar. The permanent lesson was gold. Move forward to 1991. Iraq invades Kuwait. The United States assembles a coalition and goes to war in the Persian Gulf for the first time. Oil spikes. Defense stocks surge. And gold pops, pulls back, and then begins the quieter, steadier appreciation that characterizes the years following every major oil shock. The pattern is less dramatic in isolation than 1973 or 1979, but the sequence is identical. Suppression, stabilization, recovery, new highs. Then September 2001, the most significant single-day shock to American confidence in the modern era. Markets close. The world holds its breath. And gold, which initially wobbles in the chaos of the immediate aftermath, begins what turns out to be a decade-long bull market, a run from approximately $250 an ounce to nearly $1,900. That is not a trade. That is a generational wealth event for the investors who understood that the post-crisis environment, characterized by massive government spending, expanding debt, and eventually collapsing real interest rates, is precisely the environment in which gold performs its most important function as a store of value against currency debasement. And then Ukraine in 2022. Russia invades. Energy markets convulse across Europe. Inflation surges globally. Gold initially drops as the dollar spikes and signals aggressive rate hikes. Then, over the subsequent months, gold breaks through $2,000 for the first time and holds above it, eventually becoming the foundation of a new all-time high that almost nobody in the mainstream financial press had been willing to call in the weeks when the suppression was at its most intense and the headlines were most bearish. 5 crises, 5 oil shocks, 5 identical sequences of initial suppression followed by recovery to higher ground. The time frames differ, the geographies differ, the political actors differ, but the mechanical forces, dollar strength, bond yield pressure, institutional liquidity selling, eventual exhaustion of those headwinds are the same every time, because the architecture of the global financial system that produces them has not been replaced, only stressed, and stress has a way of revealing structure rather than destroying it. Knowing that a pattern exists and knowing when to act on it are 2 entirely different skills. Most investors who eventually learn about the historical relationship between oil shocks and gold recoveries make the same mistake. They understand the story intellectually, but they have no instrument, no concrete reference point that tells them where they are inside the cycle at any given moment. They end up either buying too early, catching the falling knife before the suppression phase has exhausted itself, or too late, entering after the recovery has already made its most dramatic move, and the mainstream press has started running headlines about gold's unstoppable rise. Both errors are expensive. Both are avoidable. And avoiding them comes down to understanding two signals that the most sophisticated institutional money in the world watches with absolute consistency. The first is the 200-day moving average. If you have never encountered this concept before, here is the simplest possible version of it. Take the closing price of gold for every trading day over the last 200 days. Average them. Draw a line. That line, updated every single day as new prices come in and old ones drop off, represents the long-term trend of the market as seen by the participants with the longest time horizons. Every major institution, every central bank's investment desk, every serious hedge fund running a macro book watches this line. Not because it is magic, because everybody watches it, and in markets, the things that everybody watches become self-fulfilling in a way that transforms them from mere indicators into actual support and resistance levels. Right now, gold is trading significantly below that line. The gap between the current price and the 200-day moving average is not a small one. It is the kind of gap that has appeared only a handful of times in the last several years, and every previous time it appeared at this magnitude in late 2022, briefly in April 2025. What followed was not further decline. What followed was the beginning of the recovery phase. The pattern is not a guarantee. Nothing in markets is a guarantee. But when you look back at every instance over the last decade where gold traded this far below its 200-day moving average, you find a consistent body of evidence pointing in the same direction, and that consistency is not coincidental. The 200-day line does not tell you what gold is worth. It tells you where the largest pools of patient capital are watching, waiting, and eventually stepping in. The second signal is central bank behavior, and this one carries a weight that no technical indicator can fully capture on its own. Central banks are not traders. They do not buy and sell gold based on quarterly earnings targets or short-term momentum. They accumulate strategically over years and decades as part of a deliberate reserve management policy that reflects their deepest institutional judgments about the long-term stability of the global monetary system. When central banks are net sellers of gold, it means something. And when they flip to become net buyers, particularly at a pace not seen in a generation, it means something far more significant than any chart pattern or analyst price target. In the early months of 2026, central banks were selling gold. The reason was straightforward. The same oil shock that triggered the four-step domino sequence also cut oil revenues for several major Middle Eastern nations, forcing them to liquidate liquid assets, including gold reserves, to manage their fiscal positions. Turkey, certain Gulf states, other oil-dependent sovereigns, all of them were selling. And the headlines that followed confirmed the retail investors' worst fear. The institutions were getting out. The smart money was leaving. The trade was over. But look at what happened next, and look carefully, because this is the turn that almost nobody in the mainstream financial press reported with any seriousness. Those emergency sellers, the ones who were selling not because they had lost faith in gold, but because they needed dollars to replace lost oil revenues, stopped selling as their fiscal positions stabilized. And as they stepped back, the overall picture shifted. Central banks as a collective, as a global body, moved back into net buyer territory. Poland accelerating its accumulation. Asian central banks continuing the strategic diversification away from dollar-denominated reserves that has been building quietly for years. The structural bid, the kind of demand that does not evaporate on a bad news day because it is driven by decades-long reserve policy rather than sentiment, returned to the market at exactly the moment when the 200-day moving average gap was at its most extreme. Two signals arriving simultaneously, pointing in the same direction in a market that the headlines were calling broken, finished, and past its moment, which is precisely the combination that has preceded every significant recovery in gold across the 5 historical episodes we have already examined, and precisely the combination that rewards the investor who has learned to read the instrument panel rather than listen to the noise coming through the cabin speakers. Everything we have covered so far, the paradox, the sequence, the 50-year pattern, the two signals, is information. And information on its own does not change anything. The world is full of people who understand things intellectually, but behave in ways that directly contradict what they know. They understand that processed food is harmful, and they eat it anyway. They understand that compound interest rewards patience, and they trade impulsively anyway. They understand that buying high and selling low destroys wealth, and they do it repeatedly every time the cycle comes around, because understanding something and being the kind of person who acts on that understanding are not the same thing. The gap between those two states is not filled by more information. It is filled by a decision about identity. There are exactly two types of investors sitting in this market right now. The first type sees gold pulling back from its highs, reads the headlines confirming their fear, feels the particular stomach-tightening discomfort of a position in the red, and concludes that the story is over, that they missed the move, that the smart play now is to cut the loss, preserve what remains, and wait for the next obvious opportunity, the one that will be clearly signaled by rising prices and positive coverage, and the general social permission that comes when everyone around you is saying the same bullish thing. This investor is not stupid. They are not uninformed. They are simply operating on instinct, on the emotional wiring that served human beings extraordinarily well for 100,000 years of physical survival and serves them catastrophically badly in financial markets. Because financial markets are one of the few domains in human experience where the instinct to flee danger and chase safety, the deepest, most hardwired survival mechanism we possess, produces the exact opposite of the intended result. Running from a predator keeps you alive. Running from a falling asset price and chasing a rising one is the mechanical description of buying high and selling low, which is the single most reliable path to the permanent destruction of capital that the investment world has ever produced. The chaser is not a character flaw. It is a factory setting, and factory settings can be changed, but only by people who first acknowledge that the setting exists and then make a deliberate, conscious decision to override it. The chaser asks, what is everyone else doing? The skill builder asks, what does the sequence tell me and where am I inside it? The second type of investor sees the same pullback, reads the same headlines, feels the same discomfort, and then does something different with it. They run the pattern. They ask whether the current conditions match the mechanical setup that has preceded every significant gold recovery in the last 50 years. They check where the price is relative to the 200-day moving average. They look at what central banks are doing beneath the surface of the headline narrative. They identify which phase of the cycle they are in. Suppression, stabilization, structural bid, new highs. And they position accordingly, not based on how the situation feels, but based on what the instrument panel is telling them. This investor is not gifted. They are not connected. They do not have access to information that is unavailable to everyone else in the room. They simply made a decision at some point before the crisis arrived about what kind of investor they were going to be. That decision, made quietly, without fanfare, often in the absence of any immediate pressure to make it, is what separates the two portfolios that will exist on the other side of this cycle. One portfolio will belong to the person who sold during the suppression phase, missed the recovery, and bought back in somewhere near the next top, perpetuating the cycle of chasing that has cost retail investors more cumulative wealth than any market crash or economic crisis in living memory. The other will belong to the person who learned the rules before the moment of maximum pressure arrived, recognized the setup when it appeared, and had the conviction, not the courage. Conviction is different from courage. Conviction is what you get when understanding replaces guessing, to hold or accumulate while the headlines were screaming that the trade was finished. The rules are not complicated. They are not the exclusive property of people who went to the right schools or worked at the right firms or were born into the right families. Every mechanical pattern we have examined today, the four-step domino, the 50-year historical sequence, the 200-day moving average signal, the central bank accumulation flip, is learnable by anyone who decides that learning it is worth the effort, and that the alternative, which is remaining the kind of investor who is permanently surprised by things that have happened the same way 5 times in the last half century, is no longer acceptable